As of the latest trading session on May 26, 2026, the market has closed, and Nokia stock, trading under the ticker symbol NOK on the New York Stock Exchange, finished the day at exactly $16.46, marking a substantial intraday move upward of 6.4% on massive trading volume. If you look closely at the action leading up to this close, you can see that the trading day was incredibly dynamic, starting with an opening price of $15.99, dipping to an intraday low of $15.66, and pushing all the way to a fresh 52-week high of $16.63 before easing back slightly into the closing bell. This late May surge has completely caught the broader market off guard, especially when you realize that just a few months ago, this asset was lingering as a forgotten telecommunications infrastructure play. The immediate development that completely upends the common narrative around this legacy giant is a major strategic alliance that has institutional allocators moving capital at a blistering pace. Industry data confirms that major hyperscalers are aggressively deploying funds directly into high-capacity network hardware, and rumors of massive infrastructure spending have completely changed how retail platforms view this equity. When you open up your Robinhood app or execute trades via your Interactive Brokers account, the data reveals a fundamental mismatch between what mainstream finance expected and the actual operational reality. Most casual observers still view this firm as a slow-moving European network provider that lost the smartphone wars decades ago and has been trapped in low-margin telecommunications cycles ever since. The prevailing market belief was that Nokia stock would remain an underperforming income play with capped upside, a view frequently shared across popular investing sites. The common consensus assumed that capital expenditures from major global telecom carriers had peaked, meaning minimal growth for cellular equipment providers. However, the reality on the ground is that this enterprise has silently positioned itself as an essential backbone for hardware acceleration, capturing unexpected market share in data center routing and high-speed optical networking. This dynamic is forcing a massive structural re-rating across major online investing platforms, challenging the standard thesis that you can only find high-growth network infrastructure wins in pure-play semiconductor names. Let us dig straight into the recent market movements because the daily swings and trading volumes tell a fascinating story of institutional accumulation. Over the past few weeks, trading volume has consistently surpassed its historical daily average by over 200%, signaling that this is not just retail speculation, but massive block trading from institutional funds. If you pull up the advanced charting tools on the Interactive Brokers platform or track order flow through your Fidelity trading platform, you can see a clear pattern of accumulation during minor intraday dips. This heavy institutional presence has established a remarkably firm floor under the equity, particularly after the recent earnings release, where management posted operating margins that soundly beat consensus estimates. The market response to that earnings report was a massive validation of the corporate pivot toward enterprise web-scale business. While traditional carrier revenue remained flat, the enterprise division grew at double-digit rates, driven entirely by tech giants expanding their server facilities. This performance caused a rapid short squeeze as bearish traders who had shorted the equity based on obsolete assumptions were forced to cover their positions, adding further rocket fuel to the daily swings. Macroeconomic pressures like persistent high interest rates, which typically crush capital-intensive businesses, are actually acting as a sorting mechanism, separating firms with weak balance sheets from cash-rich operations that can self-fund expansion. To put this price action in context, we have to look closely at the broader industry momentum. The entire hardware infrastructure space has been pulled upward by massive secular demand. But while names like Nvidia stock or Tesla stock dominate the headlines, the underlying connectivity layer is where the real value is being uncovered. This structural tailwind explains why individual brokerage accounts across the globe are seeing an influx of capital into infrastructure suppliers. It is also why platforms offering automated wealth management, like Schwab Intelligent Portfolios or a specialized SoFi robo-advisor, are seeing shifting allocations as quantitative models adjust to the stock's surging momentum. Now, to truly understand the tension between market expectations and corporate reality, we need to examine exactly how this company generates its revenue and what its core business model looks like. The enterprise operates across four primary business segments: network infrastructure, mobile networks, cloud and network services, and its highly lucrative licensing arm, Nokia Technologies. The network infrastructure division focuses on IP routing, optical networks, and fixed networks, which are crucial for the high-speed data transmission required by modern server clusters. The mobile network segment provides radio access network equipment, while cloud and network services handle software-driven operations. Historically, the business model relied heavily on massive multi-year contracts with traditional telecom carriers to build out nationwide cellular networks. This classic model made the company highly cyclical and vulnerable to shifts in telecom capital expenditures, leading to years of stagnant returns and a depressed valuation that kept it off the radar of high-growth individual brokerage strategies. The brilliant pivot was shifting this exact same high-performance routing technology away from telecom towers and directly into the private data centers owned by hyperscale technology companies. By selling high-margin optical links and advanced switching fabrics to enterprise customers, the firm managed to completely alter its margin profile without needing to invent entirely new product lines from scratch. Comment below how many shares of Nokia stock you currently hold, or if you are completely avoiding the telecommunications sector right now. Hearing your direct feedback gives us an excellent look into what real market participants are doing on the ground.
Looking back at older financial reports, the company spent years restructuring its operations, cutting costs, and divesting non-core assets to heal its balance sheet. This multi-year corporate cleanup is precisely why the current operating leverage is so incredibly powerful. During past investment cycles, higher revenues were completely eaten up by massive structural overhead and legacy liabilities. Today, because the corporate structure has been completely streamlined, a significant portion of every dollar of new enterprise revenue drops straight down to the operating margin line. This fundamental change is what long-term investors using sophisticated tools on the Fidelity mobile app or tracking fundamental metrics via Interactive Brokers trading software are starting to realize. This brings us directly to the future outlook and the potential forward-looking scenarios that could play out over the coming quarters. The primary upside catalyst rests entirely on the continued expansion of enterprise data centers and the urgent need for faster optical interconnects to prevent network bottlenecks. If web-scale companies continue their aggressive capital expenditure budgets, this legacy giant is perfectly positioned to win massive procurement contracts that will sustain this high level of revenue growth well into next year. For self-investing participants looking to optimize an online investment strategy, this represents an opportunity where reality could continue to exceed conservative Wall Street forecasts. However, we must balance this optimistic outlook with a sober analysis of the operational risks that could derail this upward trajectory. The most significant threat is the potential for a broader macroeconomic slowdown that forces enterprise customers to suddenly pause or scale back their infrastructure expansion plans. Furthermore, competition remains fierce in the networking hardware space, with aggressive rivalries that could lead to price wars and margin compression, reversing the positive financial trends we have seen recently. If enterprise margins begin to erode, the market narrative will shift instantly, expectations will plunge, and investors who loaded up through online investing apps or standard brokerage accounts could see rapid downward re-ratings. Another vital variable to track is the performance of the traditional mobile networks division. While the enterprise segment is driving the current rally, the legacy telecommunications equipment business still represents a massive portion of overall revenue. If global carriers cut their spending faster than the enterprise business can grow, the consolidated financial results will suffer, frustrating investors who expected a flawless corporate transition. This is why managing allocations across different investing sites requires looking deeply into the segmented breakdown, rather than just riding the wave of high intraday volume. When you evaluate this setup against options like Fidelity ETFs, Fidelity mutual funds, or the automated allocations within an intelligent portfolio, it becomes clear that selecting individual corporate turnaround stories requires a high level of vigilance. Navigating these macro shifts is precisely why people often look for professional investment help or use advanced analytics on platforms like SoFi Active Investing to manage their positions. The key is separating short-term sentiment shifts from long-term structural changes in structural cash flow generation. To cleanly summarize our central insights, the dramatic rally we are witnessing in Nokia stock is a classic case of market expectations lagging far behind operational reality. For years, the broad consensus labeled this firm an obsolete tech relic, a narrative that kept its valuation compressed. The reality is that through disciplined structural cost reductions and a highly successful pivot into high-margin data center infrastructure, the company has fundamentally transformed its earnings power. While significant risks remain regarding legacy carrier spend and competitive pricing pressures, the current trend shows an enterprise that has successfully positioned itself at the center of modern connectivity demands. It is an instructive reminder for any online investment strategy that the biggest market winners are often found exactly where common consensus refuses to look. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.